You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, I wanted to take this opportunity to remind you all to like and subscribe. It really helps me to keep getting the best guests onto the podcast. So I really appreciate it if you did. And now onto the video. Hey guys, welcome back to another episode of Market Champions. Today we've got Brent Johnson in the house, the CIO of Santiago Capital and the Milkshake man. So thank you so much for being on the podcast.
Absolutely. Happy to be here. Always fun talking to you.
Brent, could you sort of describe your background and your journey to Wall Street and how you got to where you are today before we get into, discussing the dollar and,
Sure.
the other stuff?
Sure. Yeah, it's kind of a long and roundabout story, but long story short, I grew up in a little town in Nebraska, which is a small farming community. And for whatever reason, I'm still not sure why, I always wanted to live in a big city and thought I wanted to live in New York and work on Wall Street. And I didn't even know what a stock and a bond was, but for whatever reason, that's what I wanted to do. So, I went to school and studied hard and, was lucky enough to get a job in New York. And eventually I parlayed that into a job with a firm called Donaldson, Lufkin and Jenrette, who, put me through this Wall Street training program. And I moved with DLJ from New York to San Francisco in the year 2000. And shortly after I arrived in San Francisco, Credit Suisse purchased DLJ. So I was with Credit Suisse for 10 years after that. People have probably heard me tell this story before, but in late 2007, I had kind of a fortuitous meeting with a young couple who had sold their business and were now looking to invest it. And I convinced them to come into Credit Suisse and hear from all our experts. And in that meeting, this young couple who was very, very smart, but just didn't know a lot about finance, asked a lot of very good, but very simple questions. And, all the managing directors that were in this meeting couldn't really answer their questions. And I was a little embarrassed that they couldn't answer the questions. And I was embarrassed that I could not answer those questions. So after that meeting, I went back to my, these questions were like, what's the rate of inflation? What's the real rate of inflation? What about the budget deficit? What about the national debt? What are the implications of, running budget deficits and trade deficits? Again, not really crazy hard questions, but just, pretty smart questions. And then they asked about credit derivatives and real estate derivatives, because at the time we had this big real estate boom. And the, I'll never forget it. The wife said, well, tell me about these real estate derivatives. Do you guys trade these real estate derivatives? And they said, yeah, we do have some of those on our balance sheet, but we hedge those out. And she said, what does that mean? You hedge those out? And he says, well, we own them, but we'll hedge out the risk of it with other firms like Morgan and Morgan Stanley and Goldman Sachs. And she sat back in her chair and she said, that's interesting. Because I met with Morgan Stanley and Merrill Lynch and Goldman Sachs last week, and they said they hedge it out to you. And that's when I knew this meeting was not going to go the way that I had initially expected it to go. And after that meeting, I went back and I started, researching the answers to these questions, because my bosses didn't think these were important questions and they didn't know the answers anyway. And so that kind of started me on my, journey of self-education, rather than just learning a bunch of facts and figures that I had to learn in order to pass a test in college and high school. I actually started down the path of learning so that I actually understood. And that, right. Maybe many people understand the difference between those two, but at the time I probably didn't, right? And so that was 2007. So for the last 13 years, I've spent countless hours reading books and blog posts and obscure passages on the internet and interacting with people that I never thought I would interact with, and ask questions that are in many ways simple, but in many ways very complicated, and just trying to figure it all out. And through that process, I feel like I've come to have a pretty good understanding of the monetary system. I don't claim to have a perfect understanding, but I think I understand it better than most. And I think that gives me at least a little bit of an edge on how things will play out. Right. And along the way, that research and that search for information led me to kind of question some of the things about the monetary system. It led me to gold, and it's helped me to understand Bitcoin. And, I think Bitcoin's an important asset as well. And, it's ultimately led me to believe that the dollar is going to go higher. But through that whole self-discovery, so after the Credit Suisse issue, I realized that's not one place I wanted to work long-term. I didn't want to be part of a big Wall Street firm. I thought the incentives were all wrong. I thought the ability to help your clients was not impossible, but it wasn't easy. If that's the right way to say it. And
Right.
so I wanted to be independent. So I left Credit Suisse and joined a buddy of mine who had his own independent wealth management firm, and then ultimately set up my own independent wealth management firm. And, that's what I do now. I have, an SEC registered investment advisor in San Francisco. I help a number of individuals on their separately managed accounts. We create customized portfolios for them.
Right.
And then in addition to that, I run a fund that's, more specifically focused on, the milkshake theory, which I know you've heard me discuss before. But that's kind of what I do. And I talk to people like you.
So would you consider yourself like a hedge fund manager, or would you say you were a financial planner? What would you call yourself?
I think I wouldn't call myself a hedge fund manager. I mean, technically I am one, but I consider my fund to be more of a special purpose vehicle. We're playing a very specific theme. It's very concentrated. It's either going to work or it's not. If it works, that'll be great because it'll help a lot of people and perhaps allow us to make a lot of money. If it doesn't work, that means that the rest of the portfolio is doing fine, and we'll be okay under that situation as well. So I don't really consider myself a hedge fund manager. And if anybody ever called me a hedge fund manager, I'd probably just laugh. But
right.
Theoretically, I guess I am one.
And your Instagram handle is Santiago AU Fund. So does that stand for like gold or?
Yeah, that's actually a good story too. And along with this thing is back in the early 2000. The teens in 2012, I set up a fund that in order to own gold for clients, we owned it to physical form outside the United States, outside the banking system, and secure vaults in multiple locations. And I thought, and I still think that is a very viable and important part of an overall portfolio. Because of the length of the gold bear market, I was not able to gather enough assets to make that fund a viable going concern, so shut that down a few years ago. Doesn't mean that I don't still recommend gold, and I would very much have preferred to still have that fund open, but just it wasn't economically viable to do so. So I've left that up there to remind me of my failures. I could very easily go change that, but every day I have to look at that handle and say, you know what? Sometimes you get it wrong, and you just got to keep getting up and going forward, and right. I wouldn't still be doing this after 20 years if I got it all wrong. So I must be doing something right. But if you have any illusions that you're always going to be right and you're not going to make any mistakes, you're going to be very disappointed in this business.
That is true.
Yeah.
So I wanted to kick it off with an update on the dollar milkshake theory. So
Sure.
Since March, we've seen a bit of a bear market in the dollar. It's been going down
a bit. Yeah.
So could you give us a detailed
yeah.
update on the theory, where it stands, and then what the future is going to be like in your opinion?
So, well, the first thing I'll say is that I still think that the thesis will play out. The thesis is in a very quick way. The thesis is that as a result of all the debt in the world, we're going to have a slowing global economy that will cause defaults around the world, either in real or nominal terms. And as that starts to kick off, because the U.S. has the world reserve currency, and because most global debt is priced in dollars, it will force people into dollars, whether they want to be in dollars or not. It'll ultimately push the dollar a lot higher. And I think that's going to cause, it kind of creates this vicious loop where chaos breeds more chaos, and it just pushes the dollar higher. Now, that played out. That was starting to play out in a very big way in last year. So January to March, our thesis was, playing out just as we had envisioned. And we expected, after the big move in March, we expected a pullback in the dollar. We thought it would pull back maybe to 97 level, maybe 95 in kind of the worst case scenario. We were wrong, and so if people out there need me to say I'm wrong, I'm happy to say I'm wrong. All you got to do is look at the screen. And this is the interesting thing about finance. The scoreboard is right there. You don't have to guess, and you don't have to debate whether you're right or wrong. The market tells you every day whether you're right or wrong. The question becomes whether you will remain right or whether you will remain wrong, and whether it will turn around, et cetera, et cetera. I still believe that the thesis will play out, even though I was early, because I don't think anything has fundamentally changed. The only thing that has changed is that the problem has gotten bigger.
Right.
And this applies to my theory, but it also applies just to the monetary system in general. The design of the monetary system, in my opinion, has a fundamental flaw. And the fundamental flaw in the design of the monetary system is that it has to grow. It's not a system that has a reverse gear. And I don't have time to go through the whole design of the system, but long story short, if you don't get expansion, the system will crash in on itself.
Right.
And because after March, it happened in 2008 and 9, and then it's happened a few times along the way, and then it happened again in March. The way that the monetary authorities, quote unquote, solve the problem is that the way they solve the short-term problem is to make the long-term problem even bigger. Because the only thing that you can do is to extend credit, add more liquidity to the system, add more currency to the system, bailouts, all this kind of stuff. And while that does provide a little bit of temporary relief from this deflationary pressure, it just makes the overall problem bigger. And so, my hat's off to the central bankers and the monetary authorities. They did a very good job of keeping the plates spinning. We actually knew that they would come in. I didn't know it was going to be the exact top, but the day of the top in the dollar, I even sent out a tweet that said, listen, the central banks are going to do something. They're going to cause the dollar to go down, and if you're in the dollar bullish camp, it's going to hurt, right?
Right.
And so we knew that they would come out and institute policies. So we weren't surprised by the QE. We weren't surprised by the emergency loans or the PPP programs. In hindsight, what we were not ready for, or at least not to the extent that they did it, and the success with which they had it, was the ability to defer dollar demand. And what I mean by that is they didn't forgive debts, but they pushed them down the road. They said, you don't have to pay the interest on your loans. You don't have to pay your mortgage. You don't have to pay your rent. The IMF came out to a number of emerging market companies and deferred that debt. They deferred the debt servicing. They deferred the principal payments. And so, so they were, at the same time they were providing supply, they were deferring demand. Well, if you have a system that's based on supply and demand, and you defer demand and you increase supply, that's a recipe for price to fall.
Right.
And that's what we've seen the dollar do.
And so when did we see this problem start? Did it start off in 1960 with sort of the creation of the Eurodollar system, as Jeff Snyder has pointed out? Did it start in 1971 when Nixon took us off the gold standard? So it
really goes back even before that. It goes back to the creation of the Fed and these central banks around the world, that they have a monetary base that is actual currency and deposits at the central bank, and then all other and begin with that in a very simplistic term. Other than the monetary base, all of the money in the system is loaned into existence. So if a bank extends a loan, that's new money being created. They're not literally taking your money and giving it to them. They're using that as a reserve and then loaning new money into existence. Now, there's big arguments of whether banks even have reserves anymore, because the reserve requirement is zero. But just from a fundamental way to understand the issue, that's how it was, and that's how it's proceeded. And so, you've got these big, money supplies now, and it's not just the United States; it's the same way around the world. England, Europe, Australia, Canada, China, Japan—they all operate under the same kind of system. Some of the little rules, some of the little details are different, but by and large, the system is the same around the world. All the heads of these central banks went to schools at the same schools, and they work together and know each other, and they believe the same thing, and so it's a very homogenous system, if that's the right way to say it.
Right. Yeah.
But the bottom line is it has to grow. I think the point that you were making about the Eurodollar system is an important one, and to me, the Eurodollar system is the key to it all. Because again, without going into too much detail, the way I think that you should think about the monetary system itself is a margin account. Let's pretend that you have a brokerage account and you have money in it, and it's a margin account. So
right.
let's say you have $100 in there. Well, you can actually buy more than $100 worth of stock because they will extend you credit, right? And so you've got the monetary base, which is your $100, but then more money gets loaned into existence, so more assets can be bought. That's fine as long as the stocks you buy go up. And then if stocks keep going up, you can actually get even more credit off of that. The problem is when stocks start to come down, they stop extending you credit. And if they stop extending you credit, then we have a situation where the system is no longer growing. And to my point, just like a margin account, if the assets start to come down, you need to put new collateral into the account in order to get it back into balance. And that is the job of the central banks.
Right.
That is literally why they were created. They are to step in and provide liquidity or collateral, however you want to describe it, kind of as the lender of last resort. And so, and that's what they do. That's why the Fed did it. That's why they did it in, 2000 with the dot-com crash. It's why they did it in 2008 and 9. That's why they did it now. That is what their job is. So to think that they're not going to do it is a little silly. You don't have to like it. You don't have to agree with it, but you should understand that's their job. Now, the problem with the Eurodollar market is that because the dollar is the world reserve currency, and because the dollar is used for the far and away the majority of global trade, people all over the world need dollars. And because people all over the world need dollars, if you want to borrow money, if you borrow in dollars, you get a better rate because there's a higher demand for the dollar. So, after 2008, it started, again, back in the 60s. People would hold on to dollars. They would trade with the United States. They would get dollars in exchange for their goods. They would hold on to them because they needed those dollars to conduct foreign trade or whatever it was. And so sometimes they would just hold cash. Sometimes they would buy U.S. Treasury bonds. But it was easy for them to invest those dollars because they knew they would need them for something else. If somebody, did business with Brazil and got Brazilian reals, there wasn't a lot of demand for Brazilian reals outside of Brazil. Right. So they wouldn't hold on to the Brazilian real. I'm just using them as an example, but there wasn't a big
market,
an incentive for them to hold on to reals. So the dollar kind of became this reserve, where it wasn't just the reserve currency that was used for trade, it became the reserve asset through which people would save money around the world. And because they had these US dollar assets, and because they had these US dollar reserves, and because they needed US dollars to operate, they decided to start issuing debt in dollars. Also, because they would get a better rate by issuing debt in dollars. And so, everybody knows that the United States owes 27 or 28 trillion dollars because of to finance their government. But what a lot of people don't realize is that there's a huge market outside the United States of non-US entities who have issued US dollar debt. And that figure, depending on how you define it, is anywhere between 15 trillion, and I've seen 30 trillion, and the reality is it's probably a lot bigger than that when you start factoring in all the shadow banks and the non-financial companies that have extended dollar credit in some form or another. So this Eurodollar system, these dollars that exist outside the United States, the issue there is that, again, as long as everything's growing, as long as this Eurodollar credit's getting extended, everything works. The problem is when you get a global slowdown or a recession or whatever it is, and people stop extending Eurodollar credit, and instead they start calling in those loans. People start scrambling for the few dollars that actually exist. you get a contraction, and there's no central bank out there that can come in and provide new collateral to the Eurodollar system and re-collateralize that margin account. Now, the Fed can try to help with that with swap lines, and we saw that 10 years ago, and we saw it again 10 months ago, and I think that will become a bigger thing that we hear about in the future. But I just think this Eurodollar system is much bigger than anybody understands. It's like a spider web with a million different little strands and offshoots, and I don't think anybody has a really, really good understanding of how big it is and how deep it goes. But I know that it scares the hell out of them, and it should scare the hell out of them. And this is the point that I always like to make. And I know I'm kind of rambling on here, but I think it makes sense to put this all into context. When you hear me talk about a deflationary environment, or someone like Steve Van Meter, or someone like Jeff Snyder, or Raoul Pal, or these different people, these different people that talk about these deflation, it's not that we necessarily see deflation every day. It's just that all of these debts out there that we know can never be repaid are massively deflationary, right? Now, the counter to that is people say, yeah, but it's actually inflationary because it will force the central banks to print a lot of money to, flood the system to make,
because they can't print money. They can
that's a big part of it, right? But the point is that it's not that we don't see periods of inflation. We will see periods of inflation. We saw it many times between 2008 and 2020. Just about at some point during every year, there was inflationary expectations would rise, and then they'd roll back over, and then they'd rise again, and then they'd roll back over, and then they'd rise again, and then they'd roll back over. Now, over the last 9 months, we've seen a huge reflationary trend. So it's not that, when you see copper go up, when you see oil go up, when you see lumber go up, when you see corn go up, when you see wheat go up, when you see the price of gasoline go up, of course, we see these things. It's not that we don't see these things. We see these inflationary pressures. The question becomes, are they sustainable before another deflationary wave takes over, right? And so I'm still of the belief that we will have another deflationary wave take over. I don't think the worst is behind us, and now it's just everything rises smoothly over the next couple of years because governments will print enough currency. The point is that when governments, quote, and I know we can talk about whether they're actually printing currency or not, but the meme is money printer go burr. We're just going to print it all, and everything's going to be fine. And the point I like to make is that when they are, quote unquote, printing, they're doing it to replace capital that's dying, that's blowing up, that's disappearing. So they're trying to fill in. Imagine them, the liquidity that they're pouring in is water, and they're pouring it into a hole, or into a bucket, but the bucket has so many holes in it that the water's leaking out just as fast as it's being poured in. So you can keep pouring water in, but unless you fix those holes, you're never going to overflow with inflation. And so I think that's kind of where we're at. They've done a good job of plugging the holes temporarily, and so the bucket's filling up. But and I look at that bucket and I can see more cracks emerging. I think some of those holes they filled are going to reopen, and I think we're going to see that liquidity drain back out again, and that's deflationary.
And do you say like deflationary as in like a negative inflation rate, or are you expecting a disinflationary environment, which is just a low inflation rate?
I would say disinflationary, punctuated by sharp contractions, right? Spike downs, and then you'll see the governments will come in, they'll put some new program in place, they'll provide some new guarantee, and we'll see inflationary expectations start to peak up. But then again, until they fix the overall problem, I think it eventually rolls over. Now, one of the points you made earlier was that they can't actually print money. And I don't think we have time or the ability to go into the deep, deep weeds on bank reserves and what is not printing. But I would just say it doesn't work the way most people think it does. Right. And I encourage everybody to do their own research and come to their own conclusion on what's actually happening. But the way that the money gets into the system is that the central bank provides the money to the banks, and then the banks need to loan it on to the rest of the world, to the rest of the market. And, since 2010, the banks have gotten, the bailout funds or the QE funds, and they've used that to shore up their own balance sheets and to earn the income off of owning those reserves. But they have not, in a big and sustained way, lent that money into the market. So, and especially since, and so the velocity of money has just gone lower and lower and lower and lower.
And so has the money multiplier as well.
And so is the money multiplier as well. And so, despite all this, money printer go burr that's been going on for 10 years in the US, or it went on for 6 years in the US, and then we had a 3 or 4 year lull, and then it started again, but it's always gone on in Europe, and it's always gone on in Japan. That's why we haven't seen the runaway inflation in those places, and then the hyperinflation, despite them doing it for a decade, 2 decades, 3 decades in some cases. Now, if and when they change the rules or they provide some new ultimatum to the banks that says you have to lend this money, I think we remain in this period this environment where deflationary shocks are going to be the norm.
So like at the moment, central banks don't really have any power to force banks to lend, right?
That's right.
Yeah.
Or at least if they do have that power, they're not using it. And I'll just use the US as a good example. A lot of people will say, well, look at lending has exploded year over year since 2020. Well, that's true, but then go back and look at the details. The lending that occurred in 2020 was all between April and June. It happened because they were the PPP programs, government-backed loans. The only reason that the loans were given was because they were guaranteed by the government. As soon as those loans were drawn down, no net new loans have been made. And in fact, lending has been falling since those guarantees. Those programs are now wound down. And if the Fed wants to do those again, they have to get new authorization from Congress. So, you saw a very strong inflationary pulse since March, and I'm not going to deny that. I see it, I understand it. The question is whether it's sustainable. And I think for it to be sustainable, we're either going to have to change some laws, we're going to have to change the Federal Reserve Act. The banks are going to have to be forced via diktat or right, some encouragement to push that money into the system. But as of right now, I just don't see it.
And if people go to say the Fred database or they just Google it, from 2010 onwards, we've seen basically bank credit double, but then we haven't seen much inflation. So could you explain why that is?
Well, it kind of depends on what that's going for, right? If it's going for projects and businesses that then can become successful ongoing enterprises, then, and you get velocity of money picking up as a result, then that can be inflationary. But if you're just if lending is just piling on debt and it's not spurring continued lending and velocity of money, then you've got a situation where you're not earning any more money, but you've got more debt to service. So, debt growing means you have more debt to service. And if you earn the same amount of money, then that means a bigger portion of your check is going to service debt rather than new and efficient projects. And I think that's largely what we've seen. We've seen the expansion of debt on state balance sheets and government balance sheets and central bank balance sheets, but it hasn't gone to the efficient projects. It hasn't gone to things that the market needs and wants. And so, and I'm speaking in very general terms here. Of course, I'm sure there's exceptions along the way. But then the other, this reminded me of something else that I think is important to understand is that, how do I say, what's right? When people look at debt, there's two different types of debt. And so if you look at, if people say the debt has increased a lot, how come that hasn't led to inflation? If they're issuing, if they're issuing debt and they're using those to go do things, well, part of it is if you're issuing securitized debt is like a bond, a government bond or a corporate bond, or you borrow money or whatever it is. you're borrowing money from the market. So even though debt's going up, the money that the person who's getting that money is getting it from the market. So that money already exists.
Yeah.
That's much different than bank debt, right? So bank debt is when new money is being created. So in addition to all the money that's already out there and people are buying, securitized debt, if a bank comes in and loans new money, that's new money that's being created. In that scenario, it's not just a transfer of the existing money, it's new money being created, right? And so and if that is sustained, right, then you get a continually bigger money supply, and that can, if velocity picks up with it, lead to inflation. And listen, this will end in very, very high rates of inflation. I'm not one of these guys who's sitting here and saying that inflation is impossible. Anybody who studies history knows that eventually governments will do what they need to do to spur inflation. That's the only way to get out right from under the massive debts that they issue. My point is they have not done the things necessary yet. Now, should you always be on the lookout for that, and should you be prepared for that eventuality? Of course. Yeah. You don't stick your head in the ground and just be blind to the inflationary possibility. But the flip side is you can't, just because they say money printer go burr, doesn't mean you should go put everything you own in inflationary assets.
Right. Yeah.
So anyway.
So I want to move on to something that's related to the dollar. So I remember you were mentioning Tether days ago on Twitter. So can you sort of explain your thoughts on Tether? What's going on? What you think?
Wow, this is a big one. So the first thing I'll say is I don't claim, at least right now, to be an expert on Tether. And I don't claim to be an expert on Bitcoin. I think I understand Bitcoin very well. I'm sure there's a lot of people out there who think that I don't understand it.
You're having fun staying poor.
I'm having fun. It's funny because I've owned Bitcoin for a long time, and I don't own a lot of it, but I own a little bit. I think it's incredibly powerful. I think it can play an incredible role in helping, society to have, some individual liberty and, think for themselves and have their own sovereign store of value. But I'm not one of these people who thinks that that's automatically going to happen and that the governments are not going to fight against that. And I just really want people to understand that there's risks out there that, even if they're considering them, that they perhaps might be a little bit more big than they otherwise would like it to be. And so I've kind of gone in and out of the Bitcoin rabbit hole a half a dozen times over the last 10 years. And the challenging thing is, it seems to me, is that it's such a fast growing and evolutionary space that if you're not in it all the time, it can grow away from you. And so, if you're really in it and then you kind of go do something else for 6 months and come back, it's changed a lot.
Yeah.
So every time I kind of really get back in, now the fundamental part of it has not changed. But there's definitely some evolutionary components to it. And so every time I kind of go down this rabbit hole, I got to relearn kind of what the current, developments are, catalysts are. And, for the last couple of years, there's been this thing called Tether, which is a stable coin, which is completely different from Bitcoin. It's supposed to be a way to transfer fiat money around digitally, and provide a secure digital security, one that's not fluctuating wildly, hence the name stable coin, right? Okay, so over the last several years, Bitcoin has become, for lack of a better word, the Eurodollars of the Bitcoin crypto world, as I understand it. And there's a lot of the different players and, the big institutional actors and the retail people who will, trade in and out of different crypto assets. And when they trade in and out, they will use Tether as the exit as opposed to fiat.
Yeah.
Okay. So the idea is that every fiat dollar that goes into Tether, then a new Tether coin is issued. And so it's supposed to have one-to-one backing. Now, I know a couple of years ago, they came out and they said, well, it's not quite one-to-one.
Oopsie.
It's like 70%. And then, well, it wasn't 70% dollars. There was a loan in there that was part of the assets.
Sounds like the CDOs of 2010, 70% AAA, but then
yeah, exactly. And then and then also maybe there's some Bitcoin is in there, so the coin that it trades in and out of is also part of its reserve, and it doesn't necessarily mean that anything is wrong. It's just whenever a story starts to change and the answers aren't completely transparent, it just raises red flags for me. And when I see the amount of Tether that has been issued recently, and it happens on holidays and weekends, and it doesn't, on the surface, it doesn't make a lot of sense to me. So in the last 2 weeks, I've started to kind of really dig into that, and I've had some really good conversations. I've got some really good information. I'm very appreciative to everybody who has sent me emails and DMs and Twitters. And some people think I'm just doing this because I'm jealous because I don't own enough Bitcoin and I'm mad. I just. It's just silly. I want to understand it. And so I'm digging in, and, I'm not going to say right now, I'm not going to say anything other than, have I seen any red flags? Yeah. As I've dug, have I gotten more answers or have I gotten more red flags? Well, I've actually discovered more red flags than I have good answers as I've been digging. And, when I think I have a really good, solid understanding of what's going on, I will publicly let it be known.
Got it. So I wanted to ask you, from the dollar milkshake theory standpoint, do you have sort of a time horizon that you expect it to play out? Because I remember when I searched for the dollar milkshake theory, the first video on Real Vision of you mentioning that was in 2018. So I just wanted to ask you, do you have sort of like a time horizon where you're expecting it to play out, and if it doesn't play out by then, you're just going to conclude that you're wrong and you're going to sort of
So summer of 2018 was the first time I ever used the theory or the term milkshake theory, and that was in the very early stages. Rates were still rising. Rates were not the only reason that the dollar was rising, but certainly at the time was the key catalyst for the dollar's rise. And I was trying to explain how I thought, rising rates, along with all of the other parts of the, that I've talked about several times, would cause capital to flow to the United States.
Right.
And at the time, I don't know if I've ever had a really hard, timeline, but a year later, in summer of 2019, we set up a fund to play this theory. And when we set up that fund, we said we thought that it would play out over the next 3 to 4 years. Okay, so I guess that gives me until middle of 2023. If you want to pin me down to a hard date, I'd say by 2023. Now, I don't know if that means that it's going to play out in the next 18 months or if it takes 5 years, but I think over the next 2 to 3, 4 years that this is going to play out. Now, when COVID hit, I initially thought it was going to be an accelerant to the thesis. It turns out, because they were able to use it to defer all of the dollar demand, it wasn't an accelerant, it was a deterrent. So perhaps the timeline's been pushed out a little bit. But again, I'll say, listen, if somebody is saying, being early is the same as being wrong, I'll agree with you. I mean, in hindsight, I would have preferred to start the fund right now when the dollar's at 90 rather than when it was at 96, right? But it doesn't mean that the thesis won't still play out. Again, I don't think anybody should go all in on this thesis. I don't think anybody should take 100% of their portfolio and put it into this theory. You always have to be ready.
It's not Bitcoin.
And I don't think anybody should go 100% into Bitcoin. I don't think anybody should go 100% into gold. I don't think anybody should put 100% into anything. The idea is to, how can you, how do you do, how well do you do when you're wrong, and how well do you do when you're right? Because you're going to be wrong at times. And the other thing is that while I am highly confident that this is going to play out, it might not. And so I have to consider, because I manage other people's money, I have to consider what happens if I'm wrong. And so we have positions that will do well if I'm wrong. And the other thing about, it gets into whether you're a trader or whether you're an investor. Kind of depends on what role you're in and how you're deploying capital.
Right.
And one of the ways that you can always control risk is by controlling position size. You can take a moderate amount of risk with your whole portfolio, or you can take very little risk with a big portion of your portfolio, and then take a lot of risk with a small percent of your portfolio. And I suppose the answer is different for everybody. It all depends on your personal circumstances. But the point I'm getting at is the strategy that we're playing with the dollar is a high risk, high reward strategy. Now, we happen to think that the risk is much lower than the rest of the world, but that's what provides the asymmetry. So if it turns out we're right, we can take a small amount of money and make a lot with it. Now, in the meantime, while it's not going our way, we're losing money on that. But if you positioned that trade size correctly at the beginning, despite it doing poorly, if the rest of the portfolio is doing well, you're in okay shape.
Right.
So anyway, maybe that doesn't answer your question, but I'm not an all or nothing guy on anything. I'm not all in on anything. That's not my job. It wouldn't be appropriate for me to tell anybody to do anything 100% all in. I'm a big believer in diversification.
Got it. So, one of the things that the people on the other camp, so the inflationary camp, or, the dollar, or the dollar debt kind of camp, what they point out is that, there's lesser and lesser trade that's actually taking place in dollars. And then, they usually point to the example of Russia and China, where I believe they've dropped using the dollar in favor of other currencies. I believe they use the Chinese digital currency, if I'm not wrong. And, does that...
I don't know if Russia and China are using the Chinese digital currency. They may be, but I'm not aware of that. But I'm not saying that that's not the case. But I know the issue. I know the issue that you're talking about. And listen, here's to be absolutely clear. There's no question that de-dollarization is something that is wanted and is something that is taking place. The question is how quickly and how big and how successful. Right? There are many, many, many countries, industries, companies around the world who would love to just get away from the dollar system.
Yeah.
It's not as easy to do as it is to say. And so I think there are a number of institutionalized factors that make that much harder than if you just write a newsletter and you say, yeah, they're just going to switch to using dollars, or from using dollars to using yen. Well, it makes total sense on a piece of paper, but go try to actually do it in the real world. It's a little different.
Yeah.
And so now there's no doubt that real world actors are trying to figure this out, and that are trying to set up new payment channels and new distribution systems and new currencies and new digital assets as a workaround to get outside of the US dollar payment system. So I'm not denying that it exists. I'm not denying that there's an incentive to do so. And I'm not denying that it will eventually happen. But it just hasn't happened at scale yet. And I think it's a little bit of a case of too little, too late. And the reason I say that is I think we've got to a point where global growth is negative, and I think it's going to slow. And as it slows, it's going to create crises around all the debt that's been issued. And it's going to cause problems. It's going to take away from time and effort to figure out how to de-dollarize, and instead focus on how to get dollars to service the debt that we already have. And here's why debt, specifically US dollar debt, is so important to this problem. And this is kind of goes back to what I was talking about earlier, is if you borrow a bunch of money, well, then any revenue you have, a piece of it has to go to service that debt rather than what you would like to do.
Yeah.
Right. Let's pretend that you would like to figure out a way to get around the US dollar payment system. But if you have US dollar obligations, you first have to pay your bills that you have to pay. And then you can go off and do these projects that hopefully will lead to, growth and efficiencies and et cetera, et cetera. If part of the big issue with all this US dollar debt is the velocity of money is so low. If dollars are not circulating freely and quickly, it makes it harder to get them, And then it therefore makes it harder to service the US dollar debt. If you stop trading between two of the biggest countries, if Russia and China stop trading together, or other countries stop trading together in dollars, that means there will be even less flow of dollars. But all of that debt still exists.
So it's sort of counterproductive to what's actually.
It's in the long, yes, exactly. In the long term, it's very productive. In the short term, it's counterproductive. And this is why I've often said that if you want to see evidence that the US dollar is coming to its end as a global reserve currency, that will be the dollar rising, not the dollar falling. If the dollar's falling, that means that they are being successful in perpetuating the system that already exists.
Right. Yeah.
And you've seen that in the last, even since March, you've seen a lot of entities around the world, rather than using this US dollar weakness to pay down their debt, to get out from under the onerous, servicing of dollar debt, they've started issuing borrow even more dollar debt.
Yeah.
Right. And they're borrowing it at a lower price. So when the price rises, it's going to be even harder to pay off. So I just think that people in general, this is a very general statement, are looking at this backwards. Again, de-dollarization has happened. Someday the dollar will likely lose its reserve currency status, but it's, in my opinion, it's too little too late, and it's all about the debt. The debt is the number one issue.
So I want you to go and talk a little bit about the Federal Reserve. So what are, number one, the political limitations of the Federal Reserve from acting in the case of, say, a shortage of liquidity or an insolvency event? And also the second thing is, in your opinion, what is the probability of yield curve control, and what is the impact that would have on the dollar?
Yeah, so the first thing I'll say is you can't look at any of this in isolation. So even, let's say that the Fed comes out and says, we're going to do more QE, we're going to do more stimulus checks, and we're going to do yield curve control. That's fine. That's good information to have. That will help you make a decision. But there's still a lot more things you have to consider, like, well, what's going on in Europe? What's going on in Japan? What's going on in China? Why is it? What's happening in the market that's causing them to do more QE? Why is it that they're doing, what's happening in the market that's causing them to do yield curve control? Because if what's causing them to do all this stuff is that there's a banking crisis in Italy and it's affecting the Eurodollar market and the euro's falling as a result, well, then you have to take all that stuff into account as well. Yeah. Or maybe they're doing all this stuff because there's great volatility in the market because China was not able, they had a credit event, their real estate market stopped growing and they were not able to get US dollar funding to continue their operations. And therefore, the US is scrambling to provide liquidity, So it's not, so anyway, my point is that it's not as simple as what is the Fed doing. You have to understand why the Fed's doing it and what everybody else is doing. And then what was the other part? Sorry, what was the other part of the question?
What is the impact sort of that yield curve control will have on the dollar?
Yeah, so I mean, as a general statement, if interest rates don't rise, that takes away one of the potential benefits or catalysts to drive the dollar higher. I mean, you'll see the dollar's been a little stronger over the last couple of weeks, and a big part of it is because yields have actually started to rise, which is kind of counterintuitive, right? You think yields are rising because they're worried about fiscal deficits, but the flip side is that it's still the dollar. Everybody needs it, and if they can hold it and get paid more to hold dollars rather than paying to hold euros, okay, I'll do that. And so again, I think it would as all else equal, it would probably remove a catalyst for the dollar, but it wouldn't necessarily send it lower because again, when I talk when I talk about the dollar going lower or higher, I'm talking about versus its fiat peers. It doesn't mean that it's going to rise versus gold. It doesn't mean it's going to rise versus Bitcoin or even a basket of commodities. What I mean is that it is going to outperform all its fiat peers. And if we are doing yield curve control in the United States, they're probably doing it in Europe. They're probably doing it in Japan. And I just think that despite all the problems that we have, and listen, we have a lot of problems. I don't think we're the only ones. By a long shot.
Got it. So I wanted to ask you, with the blue suite that we just saw, and
Yep.
sort of we've got a lot of infrastructure spending, and just in general, we're going to have a lot more government spending compared to a trillion. The word trillion is basically just going to become a very small number. So do we finally see real currency debasement? We see inflation. We see the dollar go all the way to zero, and we see gold go to infinity.
No, we're not going to see that by any means. Listen, I mean, I get in so much trouble when I say this that I just kind of laugh now. But listen, I am a huge believer in gold. I think everybody should own gold. It is probably the most excellent asset in the history of the world. Okay, it'll perform. If you hold gold, and you hold it over time, whether we get inflation, deflation, war, revolution, whatever it is.
So does that mean Luke Groman is right regardless of what happens?
Well, yeah, in the long term, listen, in the long term, Luke and I agree on a lot of things. The place where Luke and I disagree is the path to get there. He thinks the path, we're further down the path than I do. And I respect Luke. Is a smart guy. He's a great guy. Like I could hang out and talk to Luke all day. He's just a great guy. I just see the road a little differently, and I don't begrudge him for explaining to people what the long-term result is going to be. And I hope he doesn't begrudge me for telling people that the road to get to that long-term might not be as smooth as everybody thinks it is. I just happen to think we're at a different place in the road. And I think that there's a lot of people who conceptually understand if you increase the amount of currency in circulation, then the value of the currency is going to fall. And conceptually, that's true. So, so he's doing a service to those who don't understand that concept. But there's just more to it than that, in my opinion. And so, I think that there's some very subtle but very important things going on underneath the surface that's going to lead to that not being the case in dollars. And so, but again, it's very possible. It's very possible that the dollar loses value versus commodities and gold and Bitcoin, but rises versus all the other fiat currencies. And if that happens, it is going to cause havoc around the world. Trust me, the rising dollar is the wrecking ball for the global monetary system. And there is nothing more bullish long-term for gold than a rising dollar.
Right. And when you talk about the rising dollar, now I feel that a lot of people who are in the deflation camp, or a lot of people who follow you, they sort of understand that the Federal Reserve is sort of printing reserves and not cash. And we don't want to get into the details of that, but I wanted to ask you, in terms of demand, is it just there's a lot of debt and the funding cost for that debt, or is there a lot of debt that's coming due? Say by 2023, which is sort of like your time horizon for playing it, So
I mean, there's a lot of debt around the world that comes due in the next call it this year, over the next 2 years. A lot of global debt comes due. A lot of it's in dollars, but a lot of it's in other currencies as well. And among those is the U.S. as well. The U.S. has a lot of money that's coming due. And that's the thing is we have financed a lot of our debt short term. And so therefore it comes due a lot more often. And with interest rates really low, that hasn't been a problem. But there's some that argue that we should lock in, a 50-year bond or a 100-year bond or something.
Or perpetuity.
At these historically low rates. And, but I think that we're going to get into, and whether it starts this year or whether it starts next, I wish I had a crystal ball for the perfect timing, but I think we are going to get into a period where rates are going to rise. And I think they will rise elsewhere before this happens in the US. So I think it will happen in the US, but I think it happens elsewhere first. I think in the short term, interest rates are going to fall, but they might not. And even if they do fall in the short term, I think we're going to get into a period of time where interest rates are going to rise. And I think they're going to rise not because things are getting better, and not because
things are getting bad.
not because of inflationary effects, but because of counterparty risk concerns. In other words, if I loan you money and you don't pay me back, and then you ask me for another loan, well, I might do it, but I'm a little concerned. I'm more concerned now, and I might charge you a higher interest rate there. So rates rise, that kind of a thing.
And with the milkshake, go on.
No, and I think when that happens, you're going to see this. Like right now, the U.S. has the highest rates, which doesn't make any sense since it's supposed to be the risk-free rate. So I think what will happen is we'll see the rest of the world's rates will rise faster than the U.S. And so even if ours are rising, theirs will rise faster. And so we'll get to a period where the U.S. is now the lowest sovereign yield again. And so that won't necessarily be bad for the U.S. But if everything's rising and the rest of the world just rises more, that could be a big problem. If everything falls again and then the rest of the world starts to rise. But long story short, I think we're going to see interest rates rising for bad reasons rather than good reasons.
And with the milkshake theory being successful, would that bring all the emerging markets to the graveyard?
It's certainly going to hurt them a lot. Yeah. As a general rule, I am not in on this global reflation. Short the dollar and allocate to emerging markets trade. I think it's way overdone and way too early.
Also, I remember the last time I talked to you, I think that was in July or August. You mentioned that you were sort of short the Hong Kong dollar peg. So could you explain sort of the dynamics of what's going on there and and sort of the reasoning behind the trade? And the second part of the question is, do you have in your opinion, it's not financial advice, but what do you think is sort of the best asymmetric trade to take advantage of the DMT?
Okay, so if we start off with the Hong Kong dollar, so the Hong Kong dollar is pegged to the United States dollar, so it just trades in a pretty flat band, and it has for 30 years or over 30 years. The way they do that, as dollars flow into Hong Kong from abroad, and then want to get invested in either Hong Kong or Greater China, the banks now have dollars, but you can't spend dollars in Hong Kong. So the banks give the central bank the dollars. The central bank gives the banks Hong Kong dollars so that they can then go spend them. Now the central bank has dollars. The way that they keep that peg steady and strong is that they use the dollars to then go buy Hong Kong dollars in the market to prop up the price of the Hong Kong dollar. And for 30 years, there's been a lot of capital, dollars that have flown into Hong Kong because it was kind of the gateway to Greater Asia or Greater China. And so, and they built up these dollar reserves. And so it's never been a problem for them to maintain the peg. The problem now, and they always had this special relationship with the United States. They got preferential trade treatment, et cetera, et cetera. But now with China taking over Hong Kong, they no longer get the preferential trade treatment. It's now that we deal with Hong Kong the same way we deal with China. They have been one of the hardest hit areas as a result of COVID. Their three biggest industries are real estate, tourism, and retail. All of those have just fallen off a cliff, and they haven't rebounded. So the amount of dollars or the amount of revenues that are being earned, have plummeted. Not as many people want to invest in Hong Kong right now, so that all the dollars are not flowing in. Yeah. And we think it's very possible that as China continues to crack down on freedoms in Hong Kong, dollars will want to leave. And the other thing is, people will say, well, they have all these reserves that they can defend the peg for a long time. Well, that's true, except those dollar reserves aren't just sitting there in cash. A lot of it's invested, some of it in long-term stuff. The amount of cash that they just have is much smaller than the overall reserves. And if people like me ever see, or if the market, let's just say the market ever sees that those reserves start getting sold in order to defend the peg, well, then everybody's going to pounce on the trade, and it's almost going to force the trade.
1992.
Yeah, so exactly. So the idea that they have plenty of reserves and they can use them to defend the peg, it's sort of correct, but it's not as strong as many people think.
Got it. And we're speaking to Brent Johnson, the man who's going to break the HKMA.
Well, we'll see.
Yeah, and
if it breaks, I will benefit from it. But whether I'm the guy to do it or not, I think that might be I think there's some other guys that probably have it on much bigger space than I do. Anyway.
And what do you think is the most asymmetric trade to take advantage of DMT? Again, it's not financial advice, so anyone listening.
It's a really hard question to answer, because I think a lot of people, when they hear me talk about dollars, they just go buy dollars, or they buy UUP or whatever it is. And the reality is if the dollar goes up 20%, I mean, that's nice, but that's not a huge return, right?
Yeah.
And so we're not just buying dollars and buying calls on dollars. We've got a number of asymmetric trades around the world that if the dollar goes up 20%, it will have huge complicating knock-on effects for a number of other markets. When the dollar went up 10%, not even 10%, the dollar went up 7 or 8% in the spring, and it caused chaos all over the world. And so we had a number of trades on that did very, very well during that time frame. So and a lot of that stuff can't necessarily be replicated by retail. But I guess my answer to you would be, you have to try to find some ways to play the knock-on effects of the dollar getting stronger. If you live in Canada, what does that mean for the Canadian dollar? Well, maybe you hold some of your savings in dollars, and maybe you don't hold as much in Canada to short some Canadian bonds or something that's denominated in Canadian dollars. Long story short, I can't tell you what the best asymmetric way to play it is, because it's different depending on where in the world you live and what currency you're denominated in. And I can't give advice over the internet, but my advice would be to just look for what are the knock-on effects of the dollar getting stronger, and what is priced really high right now because the dollar's gotten weak, and what would go in. If the dollar got really strong, it would probably cause those things to go down. So I would take a look at some of those trades.
Right. So the question to wrap it up is, it's not related to finance, but what is your favorite flavor of milkshake, or your second favorite flavor of milkshake after dollar?
You know what? I'm just a simple guy. I like vanilla, just plain vanilla milkshake.
Got it. Thank you so much for being on the podcast, Brent.
Absolutely. Thanks for having me, and good luck.